Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Friday. Happy Friday, guys. It is April 27th here. We got some important data to go over, so we're going to jump right into it. We'll start off with the GDP, or Gross Domestic Product, for the first quarter. So this is our first glimpse at the first quarter of 2018. So previous quarter, we had a pretty nice number here at 2.9% in Q4. Forecast for Q1 was supposed to be at 2%, and it came in at 2.3%. So just keep in mind this is the first revision of or first version of it. So the final version for Q1 will come out in June. So we'll have a revision in May. We'll have the final revision supposed to be in June. So just keep in mind that this could change, but this is a pretty good number. Uh, even though we're down from 2.9, but typically Q1 is one of the slowest quarters in between all of them. For some reason or another, it does usually slow up around that period, and then it kind of reheats up, or by the second quarter things start heating up, and then of course they get year end, so things even heat up. Of course, it helps that we have the holidays and stuff like that as well, so people are spending more money. But this is a pretty decent number for Q1, 2.3, and especially beating back expectations of 2%. Now, another item here we got is the employment cost index for the first quarter. This is a kind of inflationary number, kind of just shows, the cost of employment going up, as you will see here. This used to be Fed Chairman Greenspan's favorite gauge for inflation. Here was employment cost index here. Now, the previous recording came out in Q4, came out 0.6%. Forecast was up a little bit to 0.7%. It came up at 0.8%. Now, it was at year over year at 2.5%. Now went up to 2.7%. So this is the hottest number we've seen in approximately 10 years. So this is showing some that wages are going up. Now this is averaging, everything from people, young kids working at McDonald's, these type of things, to, adults working their regular jobs and stuff. So people may be worried, especially in the real estate industry here, may be concerned, well, this isn't meeting up with the a home appreciation level, so affordability is going to shrink. Well, again, a good friend of mine, Barry Habib, brought up a good point where when you take out the first quadrant, the 25% that there, because that makes up approximately 25%, and that is the people who are working those part-time jobs and stuff like that, and they're working like your fast food, and probably wouldn't be in a position to buy a home anyways. If you strip out that, the people in the three quarters above them, the other 75%, were probably closer, right around 5% increase. So, yes, even though appreciation levels are showing around 6% on that, 5% is enough, because if you take a increment, even though home prices go up 6%, we're looking at a fraction of that going up to be able to qualify for those people. It doesn't have to be percent by percent to match that. So 5% easily will help you to attain the same level, about 6-7% appreciation levels on affordability. So affordability will probably show some improvement over time here as people are are making more money on there. Even though home prices are going up, the interest rates are going up. These will show some improvement. So, anyways, I hope that helps out a little bit here. And last but not least, we got the consumer sentiment for the month of April. So our previous report came in at 97.8. Forecast was coming in a little bit up a little bit at 98, and it came in at 98.8. So overall, great day here. People are making more money. GDP was much higher. People are spending more money. And consumer sentiment, people are feeling better about where things are at. Let's kind of come to the headline news. Stock market is down currently. It did start off about mixed. We're getting good reports out there, but again, it just some of these, even though it's hitting the mark, they're hitting the mark. Sometimes it's just good news. It's just not great news, and because they're not great news, they're not really. It's not enough to help out the indices. So earnings reports, like 80% of them are hitting or exceeding the mark. So again, economy is improving, it is heating up, but because where the levels they're at now, they've been kind of on this heated path. They're really kind of critiquing. Excuse me, I had a hard time getting that word out. Critiquing what numbers they're having. So if unless they come and really blow off your socks, they're not really giving you much marks here, so they're kind of hitting you. And as an industry, you're kind of almost labeled in that same category, brought down as a result of that too. Just take a look at some of the tech sectors. Even though we have something like Facebook comes in with the great numbers yesterday, but uh, somebody else may come in and bring down the sector, or Amazon, I think, came out with some good numbers as recently as well. So, anyways, just kind of move on here to the mortgage-backed securities. We got a bond market. We broke above this level here, which used to be was a ceiling here, and broke above. Now it's a floor of support. We got a low ways to our next support here, which is a 25-day moving average. So it gives us room to potentially improve and get some improvement in our rates. But the one thing that could hold us back is now we're at the yields are down, and now they're at the floor of support. So the support could hold the yields. If this holds, then we may kind of go in the sideways pattern, may not get that improvement as we had hoped on there. But if we could break below that, our next floor of support would be all the way down here at the 50-day moving average, and that could again help us uh, see some improvement in our rates. Now, will we see a huge improvement? Not really. We might get back to the stage where we were kind of in this sideways pattern here. I don't know if we'll break above the 25-day moving average, but at least kind of get us to more respectable levels, closer levels than we were way down here. You're talking approximately 75 basis points, which is 3/4 of a point, which is a pretty significant improvement in rates. So in any case, I hope you guys enjoyed the rest of your week. We're up about 60 basis points, so translate we'll have a better price sheet today with the interest rates improving for the day. Otherwise, I hope you guys enjoy your weekend, your day, and look forward to see you guys on Monday. Thanks so much for watching. But if you guys want to see more updates, just come over to Twitter. Here's my handle at Mike Bjork. Otherwise, see you guys on Monday. Bye-bye.